I'm David Brear, and today we are talking about one of the biggest moments in a founder's journey, an exit. For many entrepreneurs, selling a business is seen as the finishing line, but in reality, it's the start of a completely new set of financial decisions. Suddenly, there are questions around tax, investing, planning, family, purpose, and if you're anything like today's guest, a flood of unsolicited emails from wealth managers you've never met before. Weird, huh? So why does financial advice often arrive at the biggest decisions have actually already been made? And if we were designing wealth management today, would it look anything like the industry we have now? That's what we're going to be exploring on today's episode. And to discuss this, we are joined by some super duper awesome guests. First up, we have Stephany Kirkpatrick, who is the founder of Pretty Smart Money and Orum. Hey, Steph, how are you doing?
Hey, David. Good morning. I'm doing great. Thanks for having me.
For anybody that doesn't know you, do you want to give yourself a bit of a background?
Absolutely. Hello, everybody. I'm Steph. I'm the former founder and CEO of Orum and a longtime certified financial planner. Actually, over 15 years of the time I've spent building in tech companies, most of that time was spent not in payments, which is where Orum was born, but actually in financial advice and wealth management. I'm the principal inventor and patent holder for a financial advice patent. And so I'm just uniquely, I think, interested in this category of financial advice and the world of wealth management. And for today, specifically, why is it so weird to have people reach out to you and want to talk to you about money when they've never actually met you? So it's going to be a really fun conversation.
Sounds great and lovely to have you on. We have also been joined by Kate Moody, who is the Customer Strategy Director at 11FS. Kate, I'm pretty sure everybody knows you at this stage, but for anybody who doesn't, do you want to remind them what you do at 11FS?
Yeah, so I suppose I wear two hats. So one of those hats is getting to meet great people like Steph on the podcast like today. And the other is working in our ventures team, so the consulting side of our business at 11FS, where we partner directly with banks, fintechs, anybody that wants to build and design new products and services in the world of financial services and money, just try and make things work better for customers. So yeah, I'm a self-certified customer nerd, so just love really trying to understand those customer jobs to be done, like what those unmet customer needs are, and really think about how we connect those into better products and services. So yeah, I'm really just excited to learn from Steph and her experience today as well.
Very cool. I feel like we actually need to make those hats for you, Kate. I feel like we could do it quite literally with Fintech Insider or 11FS swag, couldn't we? But
I wouldn't say no. I do have a very large head, like literally hopefully not metaphorically, but they'd need to be quite substantial hats.
Yeah, you meant literally, not egotistically. You're actually very, down to earth, aren't you?
Fingers crossed. We'll find out.
All right, guys, let's dive in. Steph, before we get into your LinkedIn post that really sort of spurred all of the reasons why we're here, I'd love to talk a little bit more about the period surrounding Orum joining Stripe. It must be quite a weird feeling when those things happen, and the acquisition itself, and leading a company you've started and run for a period of time through that type of exit. I mean, what was the experience like? Is it what you always thought it would be, or is there anything unexpected?
This is part of the founder journey that I think doesn't get a lot of conversation. We talk about building, we talk about the goal to have an outcome, and then nothing else. There's very little written, spoken, talked about. So I'm so glad you're asking this question. I have a little bit of a unique experience because I went through an acquisition when I was a part of the management team at LearnVest in 2015. We were acquired by Northwestern Mutual. So I had a version of what it might feel like in my head, but I wasn't the founder. And when you're in the founder seat, you're facing, honestly, the highest stakes financial decision you've ever made in your life. And not only are you having to think about those decisions that it might affect your own future, you have to think about your shareholders, your customers, your employees. So there's a really complex puzzle to put together when you're trying to find the right combination of where to land the company ultimately. And I think, one of the reasons why I find this moment so under-discussed is because, truthfully, very few people are in your corner when you have to make these choices. And you suddenly start to realize that what might be best for your board and your biggest institutional investors might not be best for your customers or your employees. And so there's just a ton to navigate. And as founders, if we're doing our job right, we always say the hardest things are to come. And I think this is one of those moments that certainly for me was ambiguous, emotional, fraught with a lot of complex decisions. And that's just leading into getting it done. There's a whole bunch of other complexities that are on the other side, most of them emotional, at least for me, but certainly one of the most complex things I've been through in my entire career.
Yeah, I can imagine it's sort of an exercise in sort of rationality and the feeling of irrationality. Your business is your baby sometimes, isn't it? When you're sort of putting everything into it and making those things happen, and the trust of people who work there, and the people who you're sort of entrusting them into. That must be quite and I should say as well. I mean, I've seen founders sell to gigantic banks, and their culture be sort of reasonably assimilated in not a positive way. But with somebody like Stripe, we've had people like Patrick Collinson on the podcast before. He's a gigantic believer in culture of businesses and structure and those things. But that must have played a big part in finding somebody that was worthy. I mean, in the nicest possible way, but to take that on and move it forwards.
Yeah, absolutely. The fit is a part of the conversation, and I think having worked at Stripe, it's such an important part of my career, and still I find myself surprised a little bit by this identity shift, and this. I write about this a lot. In fact, I posted about this last week. That once you're no longer the founder, no matter how fantastic the company, no matter how amazing the culture, no matter what big work you're working on, you suddenly have to rethink even like, how do you stop and introduce yourself? Because for a long time, you're a name, title, logo, and founder is a big part of that combination. And then you have this identity shift. And for me, it's lonely. I say to people often, it's easy to stay busy after all is said and done. It is harder to feel like you truly belong to something in the way you did when you're in the build. I think it's probably why founders repeat the journey, because part of it is easy, but parts of it are so compelling and emotionally connected that once you've been through it, you yearn for it again. And I've had to give myself real coaching to say, don't dive in too soon. But there are just myriad problems that as a creative builder mindset, you're attracted to. Coupled with the fact that there are, I think, tremendous points of influence from outside your day-to-day life, investors who backed you before that want to back you again. And so finding the right balance between, settling with what's just happened, re-identifying yourself, remembering that there's more to you than being a founder, which has been a good part of the journey for me. And then thinking about what is next, and is next necessarily a venture-backed company, or is next something that's super high impact and maybe more purpose, that transition from high ambition to purpose and meaning is something that I spend a lot of time in this kind of second chapter thinking about.
It's interesting, isn't it? You only really know what's missing sometimes when you sort of get to a place and have a thing, don't you? I worked really hard to get to a role that after having I realised I didn't want, and actually it's quite a weird feeling, that, isn't it?
It is.
It's not a waste. It's finding what you value most and the things that get you springing out of bed every day to march towards solving, isn't it? And that's it's different for everybody in that sense as well, isn't it?
It really is. And I mean, this was 7 years of my life where the good, the bad, you're surrounded by a team, you have people to go rally every day, there are customers who need you. And then one day that ends. And you might still have meetings on your calendar and super important things to do, but you really have to kind of rethink, who am I if not a founder? And that's been unusual and unexpected for me.
I feel like there's a previous founders sort of forum. It's like a self-help group we need to get people together to talk about this one. But we'll come back to that, I think, in a later episode, though, because I think it's a great thing to unpack and explore, because, as you say, there's not a lot of people who have gone through that in a repeated way.
Right.
And it takes a certain type of person to like that type of pressure and structure and everything that goes with it. But one thing that I guess clearly stood out was, with everything that happened with the announcement and the things, and what sort of brought us to have this podcast, was you shared on LinkedIn that your inbox was suddenly filled with wealth managers offering to help. You sort of described it like being catcalled, which I'll be honest, I found funny. And I think I actually laughed out loud when I read that one. But what made that experience so frustrating then? Because it's a strange one, isn't it? I bet it sort of felt like friends, only friends because of the success, essentially, which makes you sort of question everything, really, doesn't it?
Well, it's so true. Only friends because of the success is kind of the feeling. And actually, just backing up for a second, prior to writing this post, whenever I had fundraising news, people that I barely knew from high school or incidental contacts would show up in my life. NetJets would send me emails. So there's like definitely points where I'm sure other founders would tell you that, the more newsworthy you are, the more you hear from people that perhaps you weren't interested in hearing from. In this particular case, having come from a financial planning background myself and knowing really deeply how the industry works, on the one hand, I wasn't surprised. On the other hand, I was like just grossed out, because first of all, I wondered, did you not think I was worthy of talking to before? Why not build a relationship when you saw I had raised $85 million and that I might be on a path to have an outcome later? Why not build a relationship around all the equity decisions and complex tax questions, right? There are many moments in a founder's life, some of which are public, thanks to the way fundraising news works and public filings and other things, that would suggest that you could get to know me before the chapter closes instead of coming to look and not having that sort of low trust moment. And I was flooded. Name brand advisors, name brand firms, Goldman Sachs, Morgan Stanley, UBS, right? Top of the house, big wealth management teams. And they are persistent, right? Offers to get flown on a jet somewhere, invites to 11 Madison Park for dinner, like all kinds of things, shiny. And maybe for some people that works, but for me, this just doesn't land in a place where I feel like I am gaining trust with someone. It made me feel like, I think catcall was the exact word, right? Like attractive and interesting for the wrong reasons. And so I hope that by building Pretty Smart Money and starting to rethink how this all works for an industry that hasn't changed in decades, that there's a path to actually doing this right for other people and helping founders, not after they've made some of the hardest decisions, but actually before.
Yeah.
And thinking about the operators who are in tech who have the same challenges that the founders often do.
Well, like you say, if they would have been potentially useful on helping you achieve these things, you might have something of a relationship in order to talk to them. But I always find it quite funny, it's referred to as a liquidity event in this instance, isn't it? That, most people at high net worth or ultra high net worth have gone through some sort of liquidity event, which I'll be honest with you, I think it makes it sound like you wet yourself. Like it's not something that I think is like, should be an aspiration, you know what I mean? But definitely you shouldn't only try and make friends with people after a liquidity event. That doesn't make any sense either. But Kate, I mean, it feels like the wrong way round, right? People should add value in order to earn trust to then be able to help people when they're useful, not just wait until they're successful and then try and acquire them as a customer, right?
No, I was just thinking, listening to Steph, I think two of the kind of biggest problems in the wealth management space, certainly as I see them at least, seem to come through really clearly. Like first and foremost, I think there's a really outdated idea that when people have liquidity events or acquire wealth in whatever shape or form that takes you, that's kind of them done and dusted. Like suddenly you've kind of reached this tier of financial aspiration and you just want to stay there. Whereas actually, I think what Steph described is much more the experience that I've had when I've spoken to people that are, managing portfolios of different kinds. Like some people do just want to sit with that money and keep it secure and maintain a lifestyle, but lots and lots of people are entrepreneurs, are builders, have kind of those inherent desires to go and build things. And I think a lot of the current wealth management services don't recognize that. They just kind of want to manage the money. They don't want to help the person that is connected to that money to feel fulfilled, to have opportunities, to continue to build and grow, whether that's financial or personal. And then, the other part of it, which I think came through very clearly in what Steph was describing, which again, we've seen time and time again in our research, is that too many of these organizations are still orientated around like monetizing customers in the wrong ways. As Steph was sort of saying, people just pop up from the woodwork when there's, a big event and they can see, I can make this commission on this transfer or this. They're not thinking holistically about how do I build a relationship over the longer term? And maybe that means you have to think about where you make your money as a wealth manager differently. You need to be able to connect with the customers earlier on. So I think a lot of the perceptions about what people want to do with their wealth are wrong. And a lot of the ways in which wealth managers are planning to make money from the people they serve are wrong. And these are fundamentally combining to create really poor outcomes for people like Steph.
Yeah, it is a strange one. We've sort of been through these things in various different guises, Steph, and it's an interesting one. So you must have experienced it as well. And obviously, I think it's particularly a weird one when somebody who's worked in financial services for a period of time, so know how to do these things to a certain degree, you get treated like you're a child. Sort of, it's a really weird structure. It's almost like. It's like the random LinkedIn DM that nobody's looked at anybody's background to understand what they know. It's like it's just very bizarre,
right.
isn't it? But I mean,
right.
what are the things that you actually said, Steph, was the biggest financial decisions happen before an exit? But it's long before, isn't it? It's not a to your point on structure of equity or all of the things that you're doing, or understanding why you're doing all of these things in the first place. It's not a financial transaction. It's the outcome of serious intent for years and years, isn't it? So just unpack that a little bit more, because I think I feel like we're telling basically coots how to do their job at this stage in the UK, but it isn't just them, it's all of them, isn't it?
I think they all have similar patterns. And probably some of that is a derivative of the fact that the industry biases to people who are, currently the average age in the US of a wealth manager or advisor is somebody in their 50s. And that generally means that they've grown up under a framework of a bygone era, right? So I think that influences some of what we're seeing. But my take is that the best financial decisions and the most important decisions are made with more than math. And wealth management is just like one narrow piece, like finding alpha, growing my portfolio. That's just one input. I think about people in my life who influence the decisions I'm making, my values, the opportunities that shape the decisions. And so when people pop out of the woodwork with like zero relationship, it's very off-putting to try to like go build that relationship and help them understand contextually who I really am. What they're seeing with me is like dollar signs, like AUM, which is how advisors get paid. So I think there are some flaws in the overall model. But if I back up to kind of your core question, not every founder is a certified financial planner. Let's start there. So I do think it's very true that many founders have very little financial education, particularly very young founders. Think about people who get into YC from college, or they're in literally their first job as a founder. So their lived experience, they probably haven't even yet had to buy a house, run their credit for something. I mean, they're very early in their financial journey in general. And so one of the things that I think wealth managers take advantage of in that situation is the lingo and the language and this almost scare tactic that gets people to feel like you don't know, but I know, so come work with me. The problem with that is that so many of these decisions start with company and corporation actually issuing stock that's QSBS eligible and maintaining your QSBS eligibility for the duration of your holding period, which, by the way, changed last year. And then understanding what you can do after you've done your first issuance of stock. Filing that QSBS in the US is a major move, because by doing your 83B election, you set yourself up to have some portion of your sale potentially tax-free. I have met many founders who didn't know that, missed that window. They didn't incorporate with a lawyer. Maybe they incorporated somewhere like LegalZoom. And they're just too far gone to even go back and get the tax benefits, right? Then think about young founders who are going to be building for 7 to 10 plus years. They started in their early 20s, and what happens in their real life? They meet someone. They get married. Did they do any planning around prenup? Did they do any predetermination of, if this doesn't work out and I was the sole owner of the company or a substantial shareholder, what does that mean for the wealth I'm creating? And will I have to split it and share it with someone if my personal relationships don't work out? There are just so many questions, right? And really important ones that have to do with whether or not you might take on personal debt, cash out your 401k plan to put more money in a business that you couldn't raise capital for. I mean, I see everything from the lens of financial planning because I'm trained to do that. And most people see what the industry wants you to see in venture capital, which is unlimited potential, do anything you can to make it work, pour your life into it. And I believe in those things with some reason and with some financial education. And, when our first $4 million seed round hit the bank, now that's not my personal money, but I remember sitting there thinking, oh my gosh, is it insured? Is this money safe? So there's financial decisions for you individually, and there are some that actually matter at the corporate level too. And most founders figure it out as they go. And if you leave people to figure it out as they go, maybe a third will split off and kind of do their homework and ask a friend and get good counseling or advice. And everyone else will probably muddle along until the day comes that they're looking at a term sheet. And now they're making an extremely high stakes decision with zero preparation and none of the upfront help and support that could have been there to get them on the journey in the right way.
Yeah, and they're pretty painful lessons to learn by getting it wrong, aren't they? So, the advice you can get along the way and the advisors that can help you solve those problems on the journey is far more valued at the point where you've got to success, isn't it? The other point you made there about the sort of vagueness of language, people have a tendency to use big words to try and make them feel important, but don't worry, I'll take care of that for you. I'll deal with that. And I know it's complicated. Don't worry, we'll deal with all of those things, but they're creating the difficulty themselves rather than actually it being difficult. So it's a weird one. I mean, Kate, it's a much more emotional than rational journey, sort of building a business, I guess. And that's definitely something you've seen in, the people that we've talked to as well, isn't it?
Yeah, I mean, I think that kind of goes up the full spectrum of business building, right? I've spoken to people that are solopreneurs, it's just themselves, but they are so deeply passionate about their business. They will have responsibilities to obviously themselves, but potentially also to dependents. And then you go all the way up the spectrum to, companies at the scale of Orum and things like that. So I think kind of that, I don't think you get to build a business of any size or scale without really caring about what you're building, what the precise motivations are behind that are probably unique to each person. But there is a huge amount of emotion there. And I think, again, I've not had a liquidity event other than, as you were saying, like spilling some drinks or whatever. But it feels to me, at least from the outside, like there's almost a tendency to try to minimize emotion, to try and just really present this as this is about the moment where you make the most rational decision and the best decision, the best financial decision. And I just love the way you spoke about it, Steph, to kind of really try and create that much fuller picture about all the different considerations. But yeah, I think it's a super interesting space. And I did one of the other things that I think came out in the thread after your post, Steph, that I thought was interesting was people were saying, word of mouth is so important. And actually, if you kind of get a referral, and obviously, again, we see that across all of our research as well. Like, actually, if you can get a referral from someone that's had a similar experience to you, understands your values, your journey, your trajectory, then that is hugely valuable. But I do think it's an interesting challenge as well, because maybe it is biasing successful outcomes in this space towards people that have the right networks and the right people around them. And obviously, kind of one of the things that we're very passionate about here at 11FS is trying to kind of really spotlight founders, businesses across the whole spectrum, maybe people that aren't coming from necessarily such traditional founder backgrounds. I wonder if some of those people are being particularly disadvantaged in these moments because they might not have the friend next to them that's done it before. They might be forging the path for the first time. Steph, you probably know better than me.
You're absolutely right, Kate. I mean, I think like all things in financial service, the kind of key principle is if you start with access, you have access. And if you don't start with access, you're in a more challenged position to educate yourself and kind of gain traction and control. A good founder friend of mine, she's first generation US, immigrant. She's building a business in the CPG category. And we were chatting the other day and she said, I honestly don't know, Steph. Like, I've been so heads down, making this work, figuring out my product and my distribution. If I had to sell the company tomorrow, I don't know what I would make. I actually don't know how much I own of this company. And she's done multiple rounds of safe notes, so then they convert. And she's really in the dark about a lot of the decisions that affect her and her outcome. And there is no one tapping her on the shoulder pre an exit saying, let me help you figure this out. And I think that's such a miss because in a lot of cases, for this to all be interesting, you don't need to have $1 billion exit. You actually don't need generational wealth. Some people might walk away either as founders or even as operators in a company with much smaller dollars that they're receiving, but those are life-changing dollars. Remember, the average American does not have $400 in their bank account to pay for an emergency, okay? So when we get into the venture capital ecosystem and the noise and cognitive dissonance of generational wealth starts to set in, I think we lose sight of the fact that many founders have, one, potentially put all of their life savings, if they had any, into their business. Two, are undereducated. And as a result of that, they lack confidence in being able to navigate the decisions. And so much of that confidence is a derivative, not of ego, it's a derivative of knowing if A, if B, what are the results, right? Because if you go to sell a company and you make a decision about taking cash versus stock, there are so many different permutations of making this valuable to you in different ways, tax-friendly. And I do really feel that the system does not only not support founders and people who operate in tech, it doesn't support people who don't start with wealth and or who don't kind of grow up in the system where they inherit their parents' financial advisor or they have a friend who can make that referral, which is exactly why I think there's white space to build something that's never really been done the right way before, as I'm conceiving of Pretty Smart Money and not ready to say all the things it is and will do. I have a very unique take on how you would help someone find an advisor who gets them, right? Really understands who they are and what they want and can work with them in a way that helps them plan the entire trajectory, not just this single moment in time.
Sounds fantastic. We'll definitely talk about that a little bit more in the second half of the show. We're going to come back to you. We're going to be exploring what the next generation of financial advice could actually look like, whether AI, fintech, and new business models can actually build that trust that we've been talking about. So be back with you really shortly. Welcome back, everybody. In the first half of the show, we explored why traditional wealth management often arrives a little bit too late, after the big financial decisions have actually already been made. So if that is the problem, then what really should replace it? Steph, I mean, you said going through this process has changed how you think about that exit. And obviously in the first half of the show, we talked about the need to really get a very long run-up in that space. But, I guess we're talking about quite a different approach to financial management. It's not about wealth management. It's more about the sort of construction of wealth in its first principle, I guess.
Yeah, exactly. I mean, I think wealth management diminishes it, right? Because it actually narrows it to thinking only about your portfolio. And that is important as you have the ability to invest and grow your assets, whether through a liquidity event or through some other avenue. Wealth is one part of the picture, but income streams and various income streams, not just a salary, but other ways to generate income, are as meaningful as potentially building up your wealth portfolio. So I think it just, the word itself misses the broader opportunity of thinking about a comprehensive set of inputs and outputs that help you pay for the life you want now and build for the life you're going to have in the future, which may or may not include having this traditional 9-to-5 full-time career path. And so when I think about today's industry in the US, part of the reason I think that the cold outreach and this sort of ick factor exists is because the model essentially says you don't get paid on anything other than assets or products. So if you can get assets under management, you will make money. And so the industry has trained advisors to go seek that out. And hey, if you can give some advice on the perimeter, it's not bad. But the way we're licensed in the industry, the way we're compensated, it all drives back to assets under management, which then silences the conversation. And I've never had a conversation with a traditional wealth advisor that encourages me to think about how I might make different career choices. Should I take this compensation package that biases to a big bonus that I don't have total control over? Or should I take one that biases to higher cash? Should I look at a job that has better benefits for certain things versus cash compensation? I mean, there are myriad choices to make. And so I think about the framework a little bit differently because, again, kind of Confidence is the emotional outcome that I think is the win. Money will be part of that, but the emotional outcome is part of this. And so for me, there's 4 things. If you were making a high stakes financial decision and we were not calling it wealth management, I'd think about your math, right? Understand the numbers, the trade-offs, the timing, and the possible outcomes. Possible outcomes being an important one because so often you don't know what a downside scenario might be versus an upside. You really only think about the big ones. Number 2 would be your tribe. Consider the people whose lives, perspective, and support matter. I'm married to someone who is infinitely supportive of my crazy dreams to build things. And still, I don't make a decision without saying, like, how will this affect our household? Is that the right decision for us? I recently walked away from an opportunity in one of the hottest startups in New York and really almost in the world right now to take a very senior role for a, call it 9-digit compensation figure. And there were a lot of red flags. And my husband was like, but we don't need $100 million. And why would you want that job? And I had to really dig deep on, my tribe. And I think there's a third pillar, which is what I call your compass. So aligning the decisions with your values, your risk tolerance, and what matters most in your household, your family. And then last is your growth. Skills, relationships, opportunities that compound over time. The strongest decisions have all 4 of these together. And not once did we talk about your portfolio. It's in there, but it has nothing to do with the kind of framework for making the big decisions. And to me, that's what's missing.
Definitely. I mean, as you say, that's a decision-making criteria rather than a financial instrument in that sense. I mean, it's bizarre how often, and Kate, I mean, there's at least 700 episodes of this podcast where we've talked about this. So strap yourselves in, everybody, listening to this. But for me, as you say, the irony that financial services is called financial services when the service is completely missing, right? It's all of the benefits, as you say, are driven by the selling of financial instruments or products rather than actually the thing that you need. That confidence and those 4 factors that model creates, if you get those things right, is a wealth or whatever size of it or lack of it or whatever, like becomes a background factor to life, not the foreground factor, doesn't it? And that's a strange thing that people miss from these things, isn't it? Again, but you can't, there's nothing that hacks you quickly to fulfilling those 4 corners. All of them require actually thinking about it and ongoing trust from it. And, I think with the wealth industry as well, I mean, the difficulty with fintech more broadly has been that it is approached retail banking, commercial banking, payment structures as a self-service thing that you can just move all of the decision-making criteria onto the customer. But those things that you were just describing, Steph, require somebody to point them out to you and then somebody to help you guide you through those processes, because it's pretty hard to do self-reflection on your own sometimes, isn't it?
You have a million blind spots and you have your own emotions and you have a bunch of inputs. So when you're able to work with somebody who has your best intentions and outcomes in mind, it's a fundamentally different relationship. It's kind of like personal trainer, right? Of course I could, Kate, you could get on that Peloton and there are great content classes on it and strength training is one of them, but I'm never going to work as hard or even do the poses and postures right if I'm not potentially with somebody who's coaching me up, right? So I think a lot about that. Like, it's a really simple analogy, but health and wealth actually do fit really nicely together. And you have your own blind spots. No one ever does it as well as they could if they had a professional in their life. And I think that's kind of the thing I always come back to. And Kate, I'm not saying you don't ride the Peloton. I'm sure you do. I ride mine.
But I do ride the Peloton, but I do also use a coach to make me do the right things, right? So yeah, completely agree with that analogy. I mean, one thing that I thought was particularly interesting as I was listening to kind of those 4 pillars you were describing, I think was the tribe component. And I think we're often quite critical about social media, influencers, people getting advice from social media. But I do think that kind of tribe component is maybe part of why social media, financial content on social media is so compelling. Because if I think about the things that come up on my feed, it's all coming from mostly women that look a bit like me, and they speak about similar life stages to me, similar career choices to me, because the algorithm has kind of worked out that, I'm going to be much more likely to interact with content that seems like it's from my tribe, or somebody that I would recognize their life experience in my own. And so I think, a part of, that's just such a really interesting pillar to think about, because I think at the moment it's not being served, and that's probably why we're seeing so much, so many eyeballs on social media content, because it's filling that gap and people aren't getting that support elsewhere.
Well, I think, Kate, you point out something so different in today's version of social media. I often joke with Alexa Montopol, who was the founder of LearnVest, we would have never sold LearnVest if today's version of social media had existed. And I say that because in the decade plus since we sold LearnVest to Northwestern Mutual, and in the 20 years plus that I've been a financial planner, got my CFP in 2006, really three things have gotten better. Number one, direct indexing is cheaper and easier. Number two, you can buy fractional shares, and that's great. And that used to be hard, and now it's easy. And number three is social media. It's the algorithms are really dialed to a place where you can find the voices who have the knowledge, potentially the trust. And Kate, I don't think it's necessarily a bad thing to consider some of that content a part of your tribe, as an extension of the tribe, perhaps. But to me, that's actually one of the most meaningful and influential differences. It used to be your uncle, your brother, somebody in the family. And as a financial planner, I would always hear from people how they got their tips and advice. Kramer, there was a few faces out there, but not many, and not many that looked like you. And I do think that that is one of the big transformations that will continue to influence. I mean, TikTok not only saved books, thanks to Book Talk, but they are definitely playing a huge role through FinTalk in how people access information, not only about the concepts, but sometimes about products that are the right fit. And I'm not averse to products, by the way. We said financial services, biases to products. There's a time and a place for some of them. It's just a matter of knowing that they're really a great fit for you, and knowing how and when to think about those products entering the planning that you're doing.
Yeah, definitely. The sort of finding a community that's been through similar things who can guide you through those is really important, isn't it, in that sense? I guess the sad sort of part really is that we're still not getting that service though from traditional players, are we? We're living in a world where, as you say, video content can be so heavily personalized to each individual, but actually still, it's a random dude on LinkedIn reaching out. I know I've said on the podcast before, but sadly, when my dad passed away and my mum inherited everything from his side, then first thing she did was move all of the money away from the bank that she was with, because they basically alienated her for 30 years. So the experience is not. Has not moved much further forward, I would say, with a lot of the traditional players. It's very much the how nice is the pen and how nice is your suit, and how thick is the PDF you're sending to everybody to make them feel the value rather than actually generating it, isn't it? So, but I mean, Kate, that feels like a gap. It feels like technology can kind of address these problems now. So why is that not happening?
Well, I mean, first of all, I do love a good pen. So, in some ways, I feel like it. I know what my actual informed brain should be thinking about, but part of my brain is just going, I really want a pen. But no, let's be serious, I suppose. I mean, I think part of the challenge is that financial services is just such a heavily regulated space. We can't. We know what the customer outcomes are that we want, but these are regulated products that come with costs. And so I think we've still just not seen, certainly in the UK, I'm not as up to speed with maybe the US pitch. I'm sure Steph will have that lens. But I just don't think people have got their heads around how they make it commercially viable to offer financial advice to more people, which means, as Steph was saying, people are waiting for that moment when the assets under management are there just to pick up and run with. I just don't think we've seen people think innovatively enough about how they make money from customers. And that sounds like it should be a negative thing. It sounds like it should be, I'm meant to be a sort of customer researcher. Why am I talking about making money from customers? But good customer services, good customer outcomes aren't sustainable unless, these businesses are able to cover their costs and make profit and scale efficiently. So I think we have to really come back to trying to find ways to make providing advice more cost effective. Obviously, AI potentially is going to play a huge part in that, and we're still just trying to understand how that's going to play out. Certainly, we've seen initial movements from the FCA in the UK talking about kind of the interrelation between AI and advice, but we haven't really seen that ripple down into actual customer-facing propositions yet.
Yeah, I guess on the point of making making money. I mean, definitely we've seen weird things happening in the market lately, haven't we? We've seen, Coots in the UK, Steph. Used to be the Queen's Bank, so it's very fancy. They've raised their minimum, from £1 million to £3 million, in an attempt to make sure that actually there's money being made from those accounts. We're seeing gigantic wealth providers offboarding customers in the range of 500,000 to 750,000 because they can't make them profitable. And actually, that's a weird place to be, isn't it? If you can't make somebody with £750,000 under management with you profitable, that's not a good sign that actually your back office is cost efficient, that you're not layering people over bad processes to solve. And I think that really that's possibly the opportunity. But I guess, as Kate says, the advancements in technology, and particularly with AI, that feels like quite a big opportunity to turn that around.
I think AI is going to be incredibly influential in the back and middle office. I know we're in the US seeing, some early things with ChatGPT and Plaid as partnerships to basically say, link all your accounts and we'll give you financial advice. And I really don't think that is the answer. If I come back to that framework, right, it's like that misses all the key things that we were just talking about. And it also misses something where I feel like human advice has an irreplaceable component that I call emotional optimization. And there's a financially optimized answer to every mathematical input, but there's also the emotional optimization. I'll give you an example. This is less about founders, and this is just more general sort of, financial planning. When people have debt, which is in America, unfortunately, very common, there are high interest rate debts and there are low interest rate debts. And generally speaking, we're going to want to try to help you pay off your highest interest rate debt first, because it's the one that compounds like rabbits, right? It just keeps getting bigger because the rate is so high and the compounding is so fast. And so if you're talking to somebody and they have debt to pay off and they say, listen, I know that I should pay off this high interest rate card first, but the student loan debt that I've had for a decade is embarrassing, makes me feel bad every time I look at the balance. And if I'm picking the $100 to go somewhere, I'd really like it to go there. That is as good of a decision as the high interest rate debt because it's progress, right? And if you were to just have a ChatGPT answer, the math would always bias to doing the high interest rate problem first. And for many people, progress is an incredible drug, okay? I'll go back to the Peloton, right? Why does fitness start with 20-minute classes and 10-minute things? It's so that you can go on the journey to eventually run a mile or complete something material. And I think about wealth and financial planning in the same way. If you have $5 to put towards something, $5 is better than zero. And so just start. And I think sometimes that is missed. And this is where there could be plenty more education going all the way back to school, right? In our education system in the US, you learn nothing about what it's going to take to make financial decisions. And then you're thrown into the world and you have all of this stuff and it's noisy. And then we get into the problem of financial products being out there and not having a real understanding of what they do. So while I'm very pro AI, and I would say in the US in the wealth management space, we're seeing interesting entrants like Humanity Labs coming in to really optimize with agents that middle and back office. There's a ton happening with Hazel by Altruist for CRM management and financial planning, just optimized with data that's getting collected through calls and emails. Those are going to be amazing game changers, I think, in the cost structure. We still need that human. I think we're going to see a concierge level service become very, very, very valuable. I think about it a little bit like when I'm trying to navigate a canceled flight and I'm stuck in an airport. All you find people doing on the phone is saying, operator, trying to bypass, right, the automation. Humans are going to be a premium. And in the US market, we don't have enough people who enter the financial advice category as a career. There are only about 100,000 people considered advisors or financial planners. And some of our biggest wealth management shops and broker-dealers, their number one concern is staff. right? So that to me says premium for human interaction. Portfolio optimization, stock picking. I mean, all of that stuff is just going to continue to get more and more and more AI optimized and honestly, like less differentiated by firm. Those are commodities. The non-commodity is the relationship and the person who gets you and gets that list of things that your tribe, your values, your math, they all come together in a central way. So that for me is something I just hold really tight as I think about what this future looks like.
Yeah, I think that's super right. It's going to be amazing to see how far through that journey the technology can go. You know, the trust, the confidence that you talked about earlier on, the proactiveness that can come with that, the not just being sort of waiting till somebody's got a problem or waiting till they come to you, but actually proactively dealing with problems for people. It changes the context of financial services again, doesn't it? Which is, it's quite an amazing thing to think about, isn't it? If your life was something that the financial services was being done for you, how different would that feel than just the thing at the back of your head that you need to deal with that paperwork or this thinking or saving for college or whatever? It's a different feeling for life, isn't it? Which makes it sound so fluffy, but that's what it's all about, isn't it? As you said earlier on, the confidence of being able to sleep easy every night because these things are taken care of is something that I personally would pay for sure. What do you think, Kate? The technology has disrupted pretty much every financial services slither, all around the world, but still we're seeing a lot of FTPs with PDFs being sent down them. Like the wealth space definitely has a long way to go.
Yeah, absolutely. And I think Steph's completely right to call out that I do think the ideal end game will be technology plus people. I think that is the ideal outcome. I suppose I worry that people are going to get so excited about AI that, similar to what we saw with the arrival of digital banking, generally, like people's first instinct will be to just try and move everything into kind of, can we funnel everything through AI in as regulated way as possible to kind of strip out as many humans as possible? And it'll probably take that system to fall short or to break or to not achieve the outcomes that some of these companies are hoping for them to realise that they have to put some of the people back in. I guess maybe that's my pessimistic interpretation, but maybe with the likes of founders like Steph pushing on to their next ventures, maybe we'll get there a bit sooner. But fingers crossed.
So what do we expect then? 5 years from now, obviously Steph by then, Pretty Smart Money is going to be ridiculously successful as well.
Yes.
But what do we reckon in 5 years' time? What is this space going to look like? Steph, maybe starting with you.
Yeah. Well, as we said, I think the human's going to be at the center of it. And so I'm excited to continue to see humans in the financial advice arena. But more importantly, I think that execution is going to be the really critical next layer of investment that's really never been completed. So I'll give you an example. Right now, we have all this talk about agentic commerce, and I'm going to have agents who are going to go buy my trips and plan everything for me. And we are starting to see real inroads in payments for that. I think if you apply that same execution lens, when you're doing financial planning, there are lots of things that get said that are the next important step, and they require a login and a password and permission. And so the financial planner is stuck just emailing you, texting you, like reminding you to do it. And if you're me, you're like, I have great intentions. I'm going to get that rollover from my husband's old 401k taken care of, but it requires a phone call and it requires a form and I'm busy. So I think execution is going to be hugely important and probably a fee surface that's never been touched before. When I recently updated my estate plan, estate plans, like all things, are great pieces of paper. They're only good if you actually go retitle your property, your assets. Guess what? The house I'm sitting in has not been retitled in the name of the trust. But an agent could easily optimize every state, every municipality, and make those changes. So when I think 5 years out on the horizon, I think the human's still the central point. I think we're talking deep emotional optimization so that this works the way I just described. I think it will. And then like the minutia of making those things actually come to life. This is where the cost consideration used to be a problem and I think won't be as agents for execution really do enter the picture in a meaningful way. And I hope it doesn't take 5 years, by the way. I really hope it doesn't.
Well, it sounds like you're going to be building it, so it sounds like it's up to you how long it takes. Kate, what do you think? 5 years from now, what are we looking at? What does the industry look like at looking back from then?
Yeah, I mean, I don't think I can necessarily top what Steph's described. I definitely think it will be fundamentally different because of the arrival of AI. I mean, I suppose the other thing that I'm seeing from the conversations we're having with your banks, incumbents, fintechs, I think more and more people are kind of waking up to the fact that they need to start thinking less about individuals and more about family units. I think people are kind of starting to realize that their customer base is just aging, and the bottom of that funnel is not topping up in the way they assumed it would necessarily, or not looking quite the same. So I do think in 5 years' time, we'll have platforms, services, support that, yes, serves individuals, but also has to try and think about kind of broader structures, families, household units in different ways to try and fit with the way in which people's lives actually work. So yeah, a lot of AI, hopefully some more family structured money, and hopefully better outcomes.
Definitely. I think that would be what I would add. I think it's just better outcomes for everybody. That ultimately, that's what every regulator around the entirety of the world wants, is good, consistent outcomes from people. And the advancements in technology definitely can lead to that, evidencing why every piece of information led to a specific piece of advice. That's a dream from a regulator's perspective, not sort of dusty old bits of paper, but much better services for people, which is an interesting thing that would be a step forward, that suddenly we, 5 years from now, we start getting good outcomes. Weird, right? All right. Well, before we wrap up, one sentence, right? Well, let's go even shorter. Like, Kate, the future of financial advice is what?
Better.
Like it. Steph?
About the whole person.
I like it. Contextual to everybody in that. I feel like we've done a lot. I don't even have one that can top either of you two or even come close, so I'm not even going to try. So on that note, we better wrap up this discussion. And Steph, when you can come back and tell us more about your new company and the sort of run you're going to plow with that one, we would love to hear it. But for anybody trying to get in touch with you now, and I presume not stuffy old, dusty old wealth managers into your DMs, but Steph, where can people get in touch?
You can find me on LinkedIn. You can also follow Pretty Smart Money. And for those that want to watch my very embarrassing social media journey, I am on TikTok and Instagram as SKPCFP. So come have a watch. It's interesting being in your mid-40s, getting in social media. So come have a look.
Ooh.
Sounds like fun. Sounds like a lot of fun. Kate, where can people find you more?
LinkedIn, probably the best place. I mean, I have Instagram, but it's mostly just pictures of my children. So I don't think that's going to be of interest to people. So yeah, LinkedIn's probably the best bet.
I feel like they might enjoy that. You never know. People get involved with, Kate's journey through motherhood as well is always an interesting one. As for me, just drop me an email, david@11fs.com. I hope you've enjoyed this podcast. Thank you so much for listening. If you do like what you've heard, follow our podcast and don't forget to leave us a review. It helps us make the show better and helps other people find it as well. As always, if you want to join the conversation, you've just been shouting at your earphones of something that one of us said and you want to correct us or thank us or anything in that sense, find us on any platform from a social media perspective. Just search for 11FS or Fintech Insider. Or if you really want to, email us on podcasts@11fs.com. Thank you very much for listening, everybody. Goodbye.
You matched on Hinge, you're vibing. Then her energy completely changes. What do you do? I'm Raven Smith, and I wrote and read a real love story about this exact sitch. Listen to the free audiobook now.
The right window treatments change everything. Your sleep, your privacy, the way every room looks and feels. At Blinds.com, we've spent 30 years making it surprisingly simple to get exactly what your home needs. We've covered over 25 million windows and have 50,000 five-star reviews to prove we deliver. Whether you DIY it or want a pro to handle everything from measure to install, we have you covered. Real design professionals, free samples, zero pressure. Right now, get up to 45% off with minimum purchase, plus get a free professional measure at Blinds.com. Rules and restrictions apply.
Hello?
Look what TJ Maxx dragged in.
The Devil Wears Prada 2 is now streaming on Disney Plus and Hulu.
We are digital, we are downloadable, we are streamable.
The fashion event of the year is certified fresh.
Pull yourself together, we have work to do.
Critics say it's smart and witty and the perfect sequel.
That's all.
Get runway ready for The Devil Wears Prada 2 on Disney Plus and Hulu. Rated PG-13.